discussed this with government at great length. And two responses come back. One is, give a proof that if we give this incentive, people will spend more. And second, there are people who abuse it. That cannot be the basis on which you get law. If there are people assuming, you need to have guardrails to protect it. But I do hope and wish that the government does give a boost to R&D and thereby give a boost to local manufacture. That's one very important thing. The second important thing, Lata, which I'm looking to, and I'm reasonably certain that this will happen, is amendments to customs regulation. This has been one area where digitization seems to have given a go by. Huge amount of paperwork, backlog, litigation. It's estimated that about 1,52,000 lakh crores are stuck in customs litigation. And there's a huge backlog out. Can we come back? Can we first of all rationalize our rates? We have 8 rates. Can we sort of put it into a better form? Can we just have 4 rates like we did for GST? Can we do a Vivad se Vishwas sort of a thing under customs, get a lot of money released? I think that's very, very important, very critical. And actually, I'm reasonably hopeful and expecting that that's what's going to happen this time.
Yeah, and absolutely. And I think very, very important points, Mr. Kanabar, that you made. Sunil, if I can come to you, your sort of, top 2-3 expectations about where you feel there is a real likelihood of something will happen.
Okay, so I think, obviously I entirely agree with what Mr. Kanabar mentioned. Incrementally, I would say that I think the market is expecting a few tweaks in the capital gains tax regime, as well as in the bond market and in the mutual fund. So let me just quickly touch upon all three. I think there is a concern about, STT and the increased long-term and short-term tax rates which were proposed in last year's budget. And there is definitely a rationale to kind of, reduce or eliminate STT or, capital gains tax rate as the case may be. But having said that, of course, I'm conscious of the fact that the government needs to have the fiscal room to actually do that. And I personally think that if government can find the ways, and I'm sure there are ways in which you can collect more revenue, then I think this is a good thing to do. It will boost the overall sentiments of the market. We have been seeing a lot of stress on the FDI investment. Also, we've seen FPIs pulling out the money consistently for last year or so. I think if you focus on some of these aspects, it will be good. The other thing I think we should look at is the bond market. Yeah.
Right. Sorry. Let's just take it, and I'll come to you on the bond market because you have a sort of idea in terms of what should happen there as well. But Mr. Kanabar is with us as well. Mr. Kanabar, you heard Sunil, right? You're smiling, so I think you're all of us would be happy if these taxes are brought down, but it's about what we want and what perhaps is possible in that sense. So what's your sense on this point, equity taxation?
So I think actually a slightly different point of view, if I could just tell you. There has been this whole going back and forth on tax treaty interpretation. And very recently, we had a Supreme Court judgment in the case of Tiger Global, where the 2 earlier Supreme Court judgments, which was in the Azadi Bachao and Vodafone, have been, so to say, overturned, where the Supreme Court has come back to say, under what circumstances should tax treaty benefits be given? And speaking to the venture capital, the private equity industry, there's a huge amount of concern that what seemed to be a settled situation has suddenly become unsettled.
Okay.
And I know for a fact that the government is concerned about this development. And I'm hoping to see that what sort of a certainty can the finance minister provide with regard to that. I think to expect a reduction in the rate of tax, of course, it's a utopia. It's something which we all the time always want. We want a reduction of STT and we want capital gains tax to go away and we want no taxation on bonds and all of that. But all of that really does not fit within the fiscal framework. There is a merit, of course, to the point which Sunil made about parity in taxation between equity and debt. But leaving that aside, the way I would put it is that government needs to give more certainty rather than look at reduction of rate of tax. That certainty is critical. And believe me, it will give of impetus to the market.
Absolutely. Sunil, that bond market point, quickly, 30 seconds. Just quickly.
So bond market point is very simple. I think on the listed bonds, we obviously know there's a parity between listed bonds and the equity. It's only about unlisted bonds, I think, that we're talking about, that they need to be brought at par with the listed bonds.
Fair enough. Actually, even debt indexation for mutual funds was taken away, and that's been a negative too. I take your point on debt. But gentlemen, do stay on. We have to go across to Shireen, who has a brilliant panel with her. She has Anand Goenka, the president of FICCI and the vice chairman of the RPG group with her. Shireen.
Ellie, thanks. Lata, let's go straight across to Anand Goenka as the markets have moved back into positive territory. Very, very flat at this point in time. Anand, counting down, let me just check the time. We're literally just an hour away from the finance minister presenting her budget. Anand, as a manufacturer now, what is the best case scenario that FICCI's leaders are penciling in? What do you believe the budget is likely to take forward this time around?
But I think it's very important for government to continue to push to make India a manufacturing powerhouse. From FICCI side, there were a couple of ideas, suggestions that we had. One is to look at particularly creating an ecosystem for EMS sector. Just as in China, we have a complete ecosystem approach as in Shenzhen in terms of a mega electronics IT park. That will get a lot more value addition and cost benefits coming in. The second is an increased defense outlay, which will help the defense manufacturing sector, particularly in light of Sindoor and the uncertainty around the world that is happening. Two areas from the manufacturing side. The second big area that comes in place is infrastructure, whether it is data centers, power transmission and distribution. These are two large areas which will need a shift with AI coming in. And the second part of infrastructure is roads and railways to bring the cost of doing business down.
New schemes that you expect, any new sectors that are likely to fall under a PLI scheme, anything on that front, Anand, that industry is expecting? Any incentives for R&D? Is that what you're hoping for?
Yes, I think R&D innovation, clearly we have not punched above our weight here. There's a lot more that can be done. Usually what we've noticed in the budget is that the finance minister has laid out a long-term plan, whether it is giving insight into the R&D and R&D 1 lakh crore scheme or the National Manufacturing Mission. I think there will be more announcements in that nature or setting more clarity on the previous announcements that have been made. I think providing that long-term vision, continuity, will be very useful on areas such as R&D, job creation, focus on MSMEs, and leveraging the FTAs that have recently been signed.
Anand, before I let you go, I'm doing a pulse check. What is the mood within FICCI at this point in time? How many people, when we last spoke, you said that capacity utilization at 80-85%. How many people are looking at adding capacity? How many people are looking at hiring? How many people are looking at, better than average wage growth, which has been between 7 and 8% over the last few years? What's business confidence like?
Right. So post GST 2.0, we had a pre-budget survey, and we found that overall the mood is fairly optimistic. GDP growth rates are expected to be about 7 to 8%. We do expect an increase in private capex because demand has grown up. We are seeing about nearly 15 to 20% growth in the auto sector, as well as other discretionary and consumer product spends. And so as that utilization goes up, the mood is fairly positive in terms of private capex coming back.
Okay, private capex is the hope that industry is going in with, and that's certainly going to be the big wish of the finance minister and the government. Look, they've been saying for the last few years now that we've done our bit. We've given you corporate tax cuts, income tax cuts, GST cuts. What more can we do? Indian industry now needs to start doing the heavy lifting in terms of investment. But Anand, we'll come back with you once the finance minister's speech is over to decode the highlights of Budget 2020. 2026. Prashant, back to you.
Thanks very much for that, Shireen. Good chat there. And interested to see what corporates really are looking out for here. 8-point change. So markets are in the green. They're off the lows. Nigel has walked across to the big wall to tell us exactly what's happening in terms of single stocks. Nigel, over to you.
Well, for whoever's trading, Prashant, is looking a little bit better than what it was a few minutes ago, because the Nifty, as you said, has seen a bit of recovery. Your stocks like Sun Pharma actually bursting away from the Nifty pack itself. That's up closer around 3.5%. And the markets have moved into the green. Let's focus on a couple of big names then. The metal index, that's the big loser this morning. And that index, in fact, is underperforming by a mile. But there are some of these metal-sensitive stocks that are still under pressure, though they've recovered from the lows. You have MCX that should come up for you. That stock, in fact, is still lower. Let's get that stock up for you. That's lower, but that, in fact, has recovered a little bit. As is the case with Muthoot Finance as well. That stock as well, still trading in the red, but that's recovered considerably from the low. I'll tell you what, from the metals pack, if you look at it, you'll pull up a few ferrous names. JSPL, you should pull up a JSW Steel. Both of them actually are on the verge of moving into the green, or they're almost more or less flattish. While the non-ferrous names, whether you look at Vedanta, Hindustan Zinc as well as Hindalco. And from the non-ferrous names, I think Vedanta is standing out because the contribution of silver to the overall SOTP is rather low. And that's the reason why that stock has recovered close to around 7% from the lows of the day, because the contribution of silver is minimum. It's bigger aluminium play more than anything else. A few more names come up for you from the broader markets. Gala Precision, massive volumes out there, stock up 10%. IQ Lighting, that stock as well should come up for you, up close to around 10% as we speak. Big move is what we're seeing on both those two names. And throw in there Euro Pratik as well as Shilpa Medichem. All of them are flying away. So fair bit of action from the broader markets. There are a few names as well that are moving up. If you look at a PNC Infra, that stock, I think it's got beaten out of shape, but that's pulled back a little bit. And you have a divestment hope as well. IDBI Bank, that stock, in fact, is up close to around 3.5% with volumes quite high. So plenty of action actually in the broader markets, guys, though the headline index is just moved into the green. Not so bad times.
Absolutely. Thank you very much for that, Nigel. And, very snapshotty view of what's happening right now. Sajid Chinoy is with us at JP Morgan. Samiran Chakrabarti is with us at Citi. Gentlemen, good morning. Great to have both of you here. Thank you very much for joining us. We, the equity folk, get very excited, and we need... economists to bring us and keep us on an even keel, if I can say so. So thank you very much once again. It's a Sunday morning, and it's good to see both of you. Sajid, let me start with you. I read that report, and I think it's a brilliant way you capture the essence of what to expect, right? 5 questions. And there is so much in there. But, one or two things which is really top of mind as you get ready to hear the finance minister lay out the budget speech.
So, Prashant, I think first and foremost, I can't think of a time in recent years when there's been such a hostile and uncertain global backdrop. Remember, in the COVID year, the budget happened in February, COVID kicked it in March. The next budget was a year later, by which time, we had some sense of how COVID was playing out. This is truly uncharted territory where, the system that we've known for the last 80 years globally is unraveling. That creates both near-term uncertainty and creates concerns about medium-term growth. So I think the challenge before this budget is twofold. That on the one hand, when you've got all this global uncertainty in financial markets, the typical tendency of emerging markets is hunker down, right? Create buffers, create fiscal buffers, create monetary buffers, create external buffers. But, that sometimes comes at the cost of growth. Whereas the other impulse is going to be in such a, environment where, economic heft determines geopolitical heft. The tendency and the temptation will be to be adventurous and to be expansive. And so that for me is the central challenge between this budget. How do you simultaneously be conservative and be adventurous? My sense is that the way this will happen is the fiscal math will be conservative. I think, as was just said, a lot of the fiscal action happened last year. Direct tax cuts, GST cuts, with nominal GDP growth expected to be in single digits. There isn't much fiscal space, so I'd expect there'll be fiscal conservatism, which has been the hallmark of this government, to under-promise and over-deliver. I think we'll meet this year's target of 4.4, and there'll be more consolidation next year. So the numbers, I think, will be quite conservative. What everyone is hoping for is, outside the fiscal math, can we get announcements that excite not investment, and hopefully attract back capital flows. But it's that mix of conservatism and adventurism, I think, that will be key in today's budget.
Okay. Hi, Sajid and Samiran. Thank you very much for sparing time for us. Samiran, you've read the survey with a fine-tooth comb. Can you help us with what sectors or ideas may get prominence?
So thanks, Lata. I guess there are two broad questions in front of the budget today. One is about allocation of capital, both domestic and foreign. At this point of time, we have less of foreign capital into the country and more of domestic savings coming in. But within domestic savings, there is a preponderance towards equity rather than debt. How do we manage this through effective policy instruments in the short run is one of the challenges that I will be looking out for in the budget. And the second one, as Sajid was mentioning, that in an absolutely hostile global environment, we need to rethink about our broader growth strategies. The survey is indicating that we should push towards manufacturing, not only domestic side, but also manufacturing for exports. We have heard this before, but this time around, what kind of newer strategies the budget throws up to achieve that goal? I think that's also will be very important for me. So both the financial side of the economy through better allocation of capital and the real side of the economy by pushing for manufacturing in a bigger way. I think these two would be top of my mind.
Okay, let me persist with that fiscal math, which Sajid took us through, Samiran. You know, we now have the new how the new CPI series might look. And it looks like the CPI is going to be about 20, 30 basis points. Sonal Verma is saying even 50 basis points higher. Plus, the real GDP is forecast by the survey at 6.8 to 7.2. So do you think that the budget would be well within its rights to work with a nominal GDP as high as 400 trillion? Would the bond markets be upset that the calculation is too aggressive if they did that?
I think about a 10% plus nominal GDP growth in the budget, 10 to 10.5, I think will be treated by market as quite reasonable. But on a slightly different note, I think the challenge in this whole new CPI series is that the more the FY26 numbers are higher in the new series, there's a chance that the FY27 numbers will be lower by an equivalent amount because the base effect will work in the reverse direction then. So what we have written is that while we understand that 40 to 50 basis point is FY26 numbers possibly higher, but at the same time, everything else equal, there's a 25 to 30 basis point downside risk to our FY27 CPI just because of this reallocation of weights.
Okay, fair point. Sajid, what's your sense about any sectoral push? Any read-through from the survey?
A couple of things, Lata, just to finish the discussion on the fiscal math. I think it's important to appreciate that we first have to hit this year's deficit. I have no doubt we will. But just to let you know, gross tax growth, even though December was very strong, April to December is running at about 8.5%.
Lower.
And so you need an asking rate of above 20% in Jan, Feb, March to hit your budget target. There's a sense here that gross taxes could be as high as 0.4% of GDP lower than was budgeted. The good news is that there were always buffers built on the expenditure side. And you've got buffers on non-tax revenues because both PSU and RBI dividends have been very high this year. So my sense is you'll get a rebalancing in the RE number in terms of taxes and non-taxes. Lower gross taxes and lower net taxes, higher non-taxes. Similarly, in the expenditure side, don't be surprised if capex actually beats last year's target, but revenue expenditure is much lower. So the first point is just to understand how this year's math plans out. No, I think on going forward, the survey makes a very fervent, passionate argument that India has to prepare for a new world. And in a new world, that's what I began. Geopolitical heft comes from economic heft. Somebody once said very famously many years ago, the best foreign policy India can have is to grow at 10% for a decade, right? And so I think the survey lays out some of the guidelines. I agree with Shaumiran that exports have to be the centerpiece of any such strategy in a world of global value chains. And therefore, what I'm looking for is you had a series of reforms the last 6 months. What will be very important to complement it with it is on the import side. The oldest adage in economics is an import tariff is the same as an export tax or as an equivalent import tax. So this will be a wonderful opportunity to clean up the whole customs duty regime, right? Simplify it, clean it up, rationalize the rates, correct duty structures.
Yeah.
That seems to be a natural complement to the series of FTAs that we've signed. And I think the survey did talk about how protectionism upstream creates pressures downstream.
Yeah, just one quick point, Sajid. The RBI dividend number, it was 2.7 odd lakh crores last year, right? What could that be meaningfully higher? I mean, at the end of the day, gold, dollar are assets, right? Rupee is a liability. Rupee is depreciated. So could that be, could it be really chunky, bigger?
So I think this year the sense is, the dividend is going to be about 30,000 crores higher, but you're exactly right? The revaluation gains will be higher, next year if the rupee continues to depreciate. So that's one, source that has been reliable over the last few years, and that takes a little bit pressure off tax revenues next year. But again, I want the government to be conservative. I think nominal GDP of 10%, would be par for the course. Anything above could be ambitious. We're in a world with lots of Chinese excess capacity. Yes, you get some technical readjustments from the CPI rebasement, but the fact is goods prices are going to be under pressure for the foreseeable future, given what's happening out of China.
Okay, all right, got that, Sajid. Samiran, let me get you into the discussion then. The rupee weakness is something that has spooked the street, the equity markets as well. Some believe that maybe it's getting stretched on the downside. What do you think?
And what do you expect?
So it's rupees of...
No, what do you expect from the budget? Yeah.
So rupees of function of balance of payment. So what I was mentioning initially was that one of the challenges for us today is that we are not getting as much of capital inflows that we used to get earlier.
Yes.
We are a lot focused on the FPI number, but the big swing factor has been the FDI number. So in a sense, if we can push for manufacturing in a more clearer way through deregulation and all, then there's a chance that the FDI numbers can also increase. If there is more tax certainty, that could be another factor driving that FDI. But somehow to push the FDI thing will, in my view, in the budget, the best support for the rupee currently. The current account is doing just fine. So it's all will boil down to how we manage the capital flow side. I am not really very keen to look for more sources of FPI increase through different kind of tax concessions, etc. That's a very short-term approach to getting capital flows. The real big one is to get the FDI numbers much higher.
Fair point. Sajid, you have written an excellent edit on how the states also have to contribute if we have to come down in terms of debt to GDP. The center can move the needle only that much. The states have to move much more. It's possible, therefore, that all programs, like we saw in the MNREGS case, will come with more responsibilities for the state. How does it impact capex? Is there anything for the markets or for the economy from that kind of a move, which I very strongly expect, more conditions on the state?
Yes. Yeah, my worry, Lata, is that we've had the surge of cash transfers that's proliferated across states. It's now become very fashionable to do so. And as the economic survey also pointed out, these things come at a cost. And the cost has been twofold. One is you're seeing upward pressure on state deficits. We now have the RBI report on state finances. Last year was 3.3% of the deficit, which is not small. It's been widening in recent years. And there is a risk it's even higher this year. Remember, when there's a shortfall of gross taxes at the center of 0.4% of GDP, a lot of that is then shared by the states. So there'll be a shortfall of taxes for states as well, right? Number one. And number two, the other hit has been that we've just begun to see signs the last 6 months that all the spending on cash transfers affecting capital expenditure by the state. So what the center may propose, the states may dispose. So I think the real story in the coming months is going to be state finances, not central finances. And I'll say one quick thing also. Small changes in nominal GDP growth have huge implications for the asking rate for fiscal in the next 5 years. If the nominal GDP growth is 10%, the center can take its deficit from 4.4 to 3.6, most of which will happen by interest to GDP going down and meet its 50% of GDP debt target. If nominal GDP goes to 9%, is running at 9%, 7% for the next 5 years, which is not implausible, then the centre's deficit has to go all the way from 4.4 to 3%. And in that environment, if states don't consolidate, public debt on a combined basis doesn't move at all.
Sajid and Samiran, thank you very much for joining us. It's a big day. It's one of those days where, I think the markets interface with macros directly, and the big numbers make all the difference. We'll speak to you as soon as the budget speech, of course, ends for your first reactions out there. Let me toss it back to Shireen in Delhi. She's got another star-studded panel. Shireen, over to you.
Sajid, I've got a power-packed lineup here at the CII, and everyone's calling you Professor Chinoy. So thank you, Sajid, for doing a stellar job of putting together the micros and the macros for us here on CNBC-TV18. You're getting a tip of the hat here from the folks at CII who've been listening in to your conversation. But let me bring it back here to my conversation with the leaders of industry. Rajiv Memani, 30 minutes to now go. The big ask is there going to be specific measures or at least broad direction as it comes to FPI and FDI? We were chatting about this. You think the likelihood of any tax-related changes is low, but broadly, direction-wise, announcement-wise, what would you expect?
See, if you look at the overall scenario, I think the macroeconomic fundamentals are very strong. The GDP growth numbers are very strong, but we have a very uncertain geopolitical, geoeconomic environment. And we also have tax revenues that'll be lower than what the budgeted estimates are. So if you look at that, my view is, and it appears to me that there is going to be a lot of focus on manufacturing and how do you make manufacturing more competitive in India. So if there are steps around that, that makes manufacturing very clear, identify products, how India can be part of global value chains on some of those products, clear incentives, PLI schemes that are there for some of those products.
More PLI schemes, you think?
Yeah, incentive schemes, PLI schemes, whatever, depending on the product. I'm not saying for everything, but depending on what the product is. I think once you have clarity on that, then I think FDI will flow. Yes, I think from an FDI standpoint, if you were to look at concern, Shireen, the biggest concern is around, tax, legal uncertainty that happens in India. I think if we can clearly lay out whether it's advanced ruling, advanced pricing, settled negotiations, if there have been some judgments that have come up in the past, that there will not be any retrospective changes in that. If we can have those broad level assurances that are there in the budget, that India will be looking at that, then given the GDP growth, given the clear focus on manufacturing that we have, and a clear outlined path, I think FDI will pick up.
You think she will specifically address the Supreme Court order?
I don't think in the budget she will address this. That's my guess.
In her speech, maybe?
Yeah, I don't. I can't speculate on that, but I think at some stage, whether in the budget or outside of that, I think if they can specify, I think that'll be helpful.
Okay, so, lots for the manufacturing sector is what the industry is hoping for, linked to specific products, etc. And of course, that mega park that everyone seems to be betting on to further boost the EMS sector, the electronic manufacturing sector. I think that's one of the big ideas. Again, there is plenty of consensus that we may see that go through. So, Chitra, many thanks for joining us. What are you working with? What are your key expectations now?
I would want to focus again, taking off from Rajiv, manufacturing needs to be the push that we need to get forward. Clusters, tech parks to come around across the country, and also sectoral clusters is what I think we need to do so that we can, the ease of bringing the value chains closer to us is very important. There's no point in, getting things from all across the country. So this focus on sectoral clusters will be very important. The push on manufacturing is very much also there for us in the life sciences industry. And also R&D, the innovation quotient that we have to keep upping as we go forward. The public-private partnerships that are required, because the government does a fabulous job in facilitating projects and collaborations and partnerships between academia, research institutes,
so perhaps more of that.
Yes, private players like us, and
And specifically, as far as some schemes on R&D is what industry is expecting, whether or not we see a return of that, because as you heard our previous guests, the government has had this apprehension that, we give out incentives and we don't get back enough. So whether we're actually going to see a return of R&D linked incentives is the question. Mr. Bucketman is here with us. The last year it turned out to be a leaky bucket because what you were hoping for and what you had asked, the actual number delivered was much lower. So you've tempered your expectations this time on capex.
No, I haven't tempered at all. I'm just as aggressive on the ask for infrastructure spend as I always was, because the maths, it's not me saying this should be the budget allocation. It's the maths that suggests itself. Shireen, there is reasonable unanimity across political dispensations that infrastructure spend in this country should be around 7% of GDP. Now, it is also well known as a thumb rule that half of it comes from the union budget. So 3.5 should be on GDP is the infra allocation that keeps pump priming the economy. And therefore, with the expectation of a 400 lakh crore nominal GDP in FY27, 3.5% of 400 is 14 lakh crores. So the maths suggests itself. So I'm only asking for an allocation of 14 lakh crores.
You're only asking for what the math is suggesting at this point.
What the math is saying. So I'm asking for the same thing. But last year, the allocation was virtually flat. And if we were to see 14 over last year, it would be a 27% increase in allocation. And with the current uncertain environment that the world is facing, we still need public expenditure pump priming GDP growth.
Mathur, you're smiling. A 27% increase in the capex budget. Is that what industry is? I mean, if that happens, that would be a bazooka, right?
Absolutely right. And I think if we do get to the 14 lakh crore amount, that would be a bazooka, because there is no doubt the country needs infrastructure as a foundation for private sector investment as well. And we need to speeden up on railways, we need to speeden up on airports, ports, reduce logistic costs. All of this is absolutely critical.
But what's the reality on the ground? Both in terms of tenders being awarded, tenders being executed on. What are we seeing today on the ground, both from the private sector, but more importantly from the government, because that's what is doing the heavy lifting still?
So I think, to be honest, the 11 lakh crores, close to that has probably happened. But it still feels slower than what it should be. The pace at which tenders are actually coming out in the last 6 months has actually slowed down. There's a lot in the pipeline, a lot that will happen ostensibly over the next year, but actual tenders with firm dates hitting the ground. And this is the government
and the private sector both?
So this is government. On the private sector, we do see a pickup in the last 3 or 4 months. It started coming. I think it'll take time to pick up over a period of time. I think the next 3 to 6 months will be critical to see whether this is a sustained growth or just a blip on the private sector side. But we are beginning to see bit by bit growth in the private sector as well.
27% higher capex. Where is she going to fund that from?
I think it's I'm sorry to...
Burst his bubble.
Not burst his bubble. I just think that to get 3 lakh crores incremental money, when you have total revenue of 48 lakh crores, to get 8% incremental is going to be a challenge, given the tax buoyancy is not there. And they've given this thing. I think if they can find a way, I mean, my realistic expectation is somewhere between 12 to 13 lakh crores in that vicinity. But if we can find ways to also incentivize private capex, because balance sheets are under leveraged, banks have a lot of money, there's also a lot of cash circulating. So if we can push...
what can they do?
No, I think the government has been doing a lot in terms of reforms. I think that's reflecting in the growth in capex that has happened. And private capex is happening. It's not that private capex is not happening. But I think it can be, hopefully, if we can move on projects faster, if there's greater focus on ease of doing business, clearances come faster. As Suchitra said, availability of land, power cost becomes more competitive. We have a clear glide path on 50 to 60 products that India needs to go after, or 70, 80, or 100, whatever that number is. I think investments will come in. I think we need to get the projects ready, whether it's PPP, whether it's otherwise, and move fast on the approval process. I think that is more realistic.
So, Vinayak Chatterjee, there is no consensus even on this panel to go with your number.
I'm not asking for consensus. I'm only saying there is a macroeconomic maths, and the maths suggests this figure. That's all I'm saying. I'm not even asking for consensus.
But I think, just to go on to that, Shireen, it's not only about the funding, and both Rajiv and Vinayak have their perspectives. It's also on the implementability, right? So you can put whatever you want the number you want. Yeah. It's actually got to be implemented. And the government has got a very good track record of now implementing 80 to 85% of the number that they put out there. So I think it's also important to take that factor in to see how much actually can get in.
It's interesting in terms, there's something I wish to point out as a very interesting change in the conversation that I'm noticing. Traditionally, the budget allocations on infra would be Jal Jeevan Mission, Pradhan Mantri Gram Sadak Yojana, Awas Yojana, NHI, those nice public. See what the language today is. Even pre-budget, we are talking high-speed rail, coal gasification, battery storage, nuclear, semiconductor, hydrogen. So the nature of the incentives and the allocations
and the sectors
we have moved from, I think it's an important shift in the budget lexicon, that we are shifting from traditional public sector driven Aam Aadmi type of stuff to new age infrastructure technologies being incentivized. I wanted to point that out.
No, that's an important shift that you talk about, and I suspect that we are going to see that being reflected in the budget. But Rajiv, of that basket of sectors or items that you spoke of, the top 5 that you believe will get some mention in the budget.
I would say electronics manufacturing for sure. That's been manufacturing for sure. I think semiconductors definitely. I think nuclear is another area. It'll be really good if coal to gas comes in. I think we have to find a way that we unlock our mining resources faster, because that gives a lot of focus on growth. I've not thought about what the top 5 will be, but these comes immediately.
Well, you've given us 4 already.
And some labor-intensive sectors, because I think it's very important that we focus on those as well. So. Because employment generation is a key objective, and AI and data centers will that'll always be there.
That will find a mention. Rajiv Memani, Suchitra, Vinayak, and Sunil, many thanks for joining us here at the CNBC-TV18 CII Budget Headquarters. We'll have you back to not speculate, but to actually analyze the fine print and whether or not Vinayak gets what he wants, and he believes the macro. He's kind of like already like giving up on it. But thanks very much for joining us. That's the mood here at the Confederation of Indian Industry.
Ask for the stars and land in the moon.
Land on the moon. Ask for the stars, land on the moon. That's the mood here in industry. But the Nifty Bank almost 200 points higher. Prashant, back to you.
Well, the market mood is the mood amongst corporates in Delhi is keep expectations high here. Okay, market expectation is low. So the bar for being surprised positively, perhaps. But that's market's view, right? We've seen a big turn, Shireen. We were down in 60, we're up 60 on the Nifty, 25,384. But of course, all of this will, diffuse as we go into the budget speech at 11, kind of flattens out, and then the market will hear the speech, and depending on, of course, what comes through, the reaction starts to, sometimes when it's actually late into the speech, even after the speech, the real reaction starts to kick in. The metal index is still down 2. It's off the lows by a little bit. The Sensex is up a third. The Nifty is up about 0.25%. So those are the 3 big kind of indices we're going to talk about. We'll take a quick commercial break here. On the other side, we have Sandeep Bhatia, MD and Head of Equity India, Macquarie Capital joining in. Mahesh Nandurkar of Jefferies is going to be with us. And we also have Ashok Vadla, Group CEO, Ambit joining in. Dinesh Kanabar will be with us as well. Anant Narayan, a former SEBI official, is also going to be with us. He's, of course, written a powerful piece which many have cited as a reason why perhaps equity and bond market taxation perhaps needs to be given a relook. So all of that coming up in just a bit. Okay, welcome back. There's 15 minutes to go for the finance minister to start reading out the budget speech, and it's a power-packed panel we have with us here. And so this is last-minute kind of wishes, expectations, high-conviction ideas, whatever you want to call it, right? Sandeep Bhatia is MD and head of India Equity at Macquarie Capital. Mahesh Nandurkar of Jefferies is with us. We have Anand Narayan who's with us. We have Ashok Vadva, Dinesh Kanabar. So, gentlemen, all of you, good morning. Great to have you guys on a Sunday morning, and it's an important one. Anand, before I took that break, I was saying that you wrote that piece, and I think it's been widely circulated as perhaps, and many people are basing their arguments on the back of what you've said. Well, this should be done. So, just with 15 minutes to go for the speech, just quickly in a minute, tell us 2-3 points what you think should happen. I'm not saying will happen, but what you think can happen.
So very quickly, Prashant, I think there are two areas where our taxation, particularly on long-term capital gains tax, needs to be relooked at. One is with respect to foreign investors, the other with respect to our domestic investors. Globally, the major markets follow the OECD model of applying capital gains tax at the residence of the investor, not at the source where the investment is made. India is an aberration in that we have withholding tax on long-term capital gains on a residence-based model in India. Now, while we have tax treaties and such like, it is still a problem for global investors, A, because it's an aberration, B, because many investors are actually exempt from paying capital gains tax in their home country, and for them, any withholding tax in India is a problem. Third, even if you are liable to pay capital gains tax in your residence, the withholding that we do in India sometimes does not conform with the tax credit regime that they have in their country. And finally, we compute our capital gains in rupees. At a time of rupee depreciation, when the investor might actually be having a loss in dollar or in hard currency terms, this becomes a problem. So all of this, therefore, tells you that we should probably look to moving towards a residence-based taxation model as well, and do away with the need for withholding tax for foreign investors in India. This is not exempting them and penalizing domestic investors. This is merely moving to the global model of ensuring that it's a residence-based taxation. Similarly, for the domestic investors, Prashant, I would argue that we've seen a lot of new investors coming into capital markets, which is great. But if you see the skew of investments, 10 years ago, mutual funds had twice as much assets in fixed income as they had in equities. Today, it's the reverse. You have twice as much in equity than you have in fixed income. Now, if this was entirely because of risk appetite of investors, that's fine. But I would argue that taxation has played a role in this. 5 years ago, you would recall, fixed maturity plans used to be a thing. And today, they don't exist as a product. So I would argue that taxation is actually skewing investor asset allocation choices away from their risk appetite and possibly into riskier assets. Now, if you start taxing fixed income, particularly corporate bond and hybrid investments, at the marginal tax rate of your investors, that actually becomes more like a wealth tax because you're not doing indexation. Then for after paying a marginal tax rate for fixed income returns to beat inflation becomes that much more difficult. And I would argue if you're investing in corporate bonds or in InvITs or REITs, you're taking considerable risk and aiding good quality capital formation as well. So over time, I would love to see our taxation regime move towards an asset agnostic, uniformly low long-term capital gains tax regime. Now, all of this, if this creates problems in terms of tax collections, maybe we could relook at STT. After all, STT was supposed to be in lieu of long-term capital gains tax. But these two things, A, moving to a residence-based taxation for foreign investors, making it easier for them to invest in India, and B, moving to an asset-agnostic, low uniform LTCG regime for Indian investors in India, I think would be great for capital formation and investments in India.
3 cheers to you, Anand, for that. By the way, your analysis on CNBC-TV18 has also attracted, I think, record eyeballs on this issue. Quickly, Sandeep, how do you think the market will react? I mean, the ultimate that Anand is saying of, equality of taxation for equity and debt, it ain't happening anytime soon. But even if there is one step towards it, like, continuing with reintroducing indexation, I don't know what they would do. But if there is a step towards it, markets will be happy?
Definitely. I think markets will be happy. But I am actually going to go into this budget very circumspect. I think there are issues on long-term capital gains tax. The thought process has been to raise the long-term capital gains tax level. So Anant is actually saying the right things, but whether the right things get done or whether we move towards higher taxation even on capital gains tax, because there's enough data which can prove that the capital gains tax is paid by the wealthy in India, and therefore the wealthy can be taxed more. So I don't know whether this will mean lower taxes on capital gains tax or actually just moving towards higher taxation, which is currently the bane for debt taxation.
I don't know if
so. That's one thing which I'm circumspect on. And the other thing is, I think also gold and silver ETFs could see some more restrictions because these are unproductive investments always. The whole idea behind sovereign bonds was that these should be financialized and used, but then of course the gold prices went up, and therefore then it became
so Sandeep, so import duties go up in gold, silver. I mean, that's if you look at where
that would be very negative. I think it will just help smuggling. I think maybe they will take away the long-term capital gains tax benefits there. Who knows?
Yeah.
I think we should go with very circumspect because there's definitely pressure to raise revenue. We just saw the GST numbers come in, flash today at 6% for the month of January. So let's hope for the best, but let's not keep hoping too much.
No, I agree. Actually, like you, the market is also going circumspect. We haven't seen any all guns blazing entry into the budget. But let us go more threadbare as to what Anant said, because we have two tax experts over here. Yeah. First to you, Ashok, taking from Anant's point of view, what would be your feasible, ideal tax change?
What Anand says makes sense from a global OECD model perspective. But given our current tax position and the fact that we've only had marginal growth this year, largely because there were tax cuts last year and then GST cuts this year, I don't think we have the headroom to be able to do that. Going forward, perhaps a roadmap that can identify it as an opportunity, sure. But I think the two small steps that we can surely take is why have AIF on a different tax regime to mutual funds? I mean, if you think about it, the wealthy who you want them to come more and more to the market, because at this point of time, our market needs more support. With FPI selling out the way they are selling out, I would like to believe that domestic...
what Sandeep said, right? He almost made it like it's ideological kind of thing. You can tax the wealthy. Products like AIFs, I mean, at the end of the day, the category of investors is different. I mean, it's more HNI and wealthier.
It's only creating an arbitrage.
No, I'm not saying right or wrong.
I'm saying between mutual fund and AIF, you're creating an arbitrage, which is absolutely unnecessary. It's one category versus the other category.
Yeah.
All that I'm saying is that the first step could be to say, okay, we'll harmonize the two and make taxation between AIFs and AIFs were really created as a vehicle to attract more investments into the market. And we've seen the benefit. I mean, you've seen how much money AIFs have been able to collect. So I would say the first step would be to try and see whether you can rationalize the two together. And on the other side of FDIs and not taxing, let's at least include insurance companies in investing in infrastructure projects. Today, you have sovereign funds that are exempted. You have pension funds that are exempted, but insurance companies, including domestic insurance companies. I mean, there's a large pool of capital waiting to invest in long-dated assets. And infrastructure needs that capital. We are calling upon private sector to invest. And here is a large pool of capital sitting with domestic insurance companies that can go in there. So why not include at least insurance companies in investing in data centers and investing in all of the infrastructure projects? I think at least it's a step forward towards attracting a larger pool of capital. And again, a small step forward to what Anand said.
A fresh idea.
Yeah. And then, of course, if you can exempt sovereign funds and insurance companies from any investment, you bring in a new category. Say anybody who's investing for more than 5 years, investments more than 5 years shall be exempted from any capital gains tax in India. I think that would be a fantastic idea.
So you're not kind of sort of flip-flopping?
No, you're keeping your current regime. Yeah. You're just bringing a new category to say any investment made for more than 5 years by any of these investments, doesn't matter whether it's in infrastructure or in any other category of investment, exempted from India.
Mr. Kanabar, similar question.
Just a very quick thing. Unfortunately, while Anand makes a very nice point, which is very attractive, actually the OECD is going in a different direction. They've actually come back to accept that India's approach of taxing on a source base is more appropriate and more countries are adopting it. So while he's advocating that we need to move away from...
I looked at France, in UK, Germany, all of them have equal debt and equity taxation?
No, that's separate.
No, she's talking about
source versus residence.
Okay.
So OECD has actually in the last 2-3 years done a somersault to come back and say source-based taxation is actually an acceptable thing. I think the point which Anand makes, which are very important and right, is how do you tax notional income when you compute gains on the base of rupees? You can't be doing that. You have to give into account the currency of investment that is given. And I think the parity on debt and equity has merit in its own way. And I think I'm aware that it is being actively considered. Whether it will happen in this budget or not, I don't know. But lots of points to do out there. Yes.
Just one quick point. Gold and silver, as Sandeep was talking about, ETFs. And I mean, if you look at the way how prices were trading, markets are betting on. I mean, the spreads are locked in. So much of arb trade, etc., has happened.
So as you know, that wherever the government has found that there is a degree of...
Actually, there is one consensus expectation that import duty is coming. That is, I can tell you. I mean, at least long term and all, we don't know. But this gold, silver import duty, markets are betting on. Your thoughts?
Wherever there is a betting, actually the withholding taxes goes to highest rate, 30%. And it is quite possible that at least that will happen. Whether import will come or not is, as Sandeep rightly mentioned, an issue of smuggling and whatever else unofficial channels coming. But to say that wherever there is a degree of betting happening, we will tax it. So the race horses, same thing. It's 30% tax. Same thing could happen to some.
So speculative kind of activity without okay, so that's another way to look at this. Mr. K.K. Mistry is also with us. He's, of course, veteran banker, needs no introduction. Mr. Mistry, good morning, sir. Thank you very much for joining us. We don't have to wait very long, 7 minutes to the budget speech beginning. So I guess top 2 or 3 sort of high conviction ideas, bets that you would have, hopes that you would have from the finance minister today.
All right. So I think first focus should be growth in the economy, creation of jobs. We still haven't taken into account the fact that in the next 3-4 years, we'll have a lot of artificial intelligence in India, and that could result in some challenge on jobs. So job creation, further pick up in consumption in some way or the other, because we continue to remain a consumption-driven economy. Manufacturing is critical for us. We are way behind on manufacturing compared to where we need to be. So something like an investment allowance that used to be there, or an accelerated depreciation, or some changes in the PLI scheme is something which could happen. And then capital markets. I was hearing your debate. I fully agree. I think the taxation for debt and equity should really be the same. There should be no difference between equity and debt. And also, I think Ashok said that any capital gains beyond 5 years should be fully taxed.
Mr. Mistry, if you do that, won't banks have a big problem? Or are you saying that for both?
They'll be advantaged.
No, banks will. If you
you need to understand that when money moves from one account to another account, or if I buy a share or you sell a share, the money moves from my account to your account.
No, Mr. Mistry, for the banker, it is not equally advantageous. You have to keep a higher HQLA in fast-moving money like mutual funds. And if it's a term deposit, you have to keep almost no HQLA. So they get to spend more, get to loan more when they get term deposits. So they will complain if interest income is not given a little bit of relief. But anyway, now everyone is asking. It's a big ask.
It's a very, very big one in that sense. But is that something you would wish may happen, but you're not? I mean, it's an idea, Mr. Mistry, right? That's what you're saying.
It's an idea. It's an idea. What I would like to see, which I'm sure is not going to happen, is some change in the individual tax rate. You bring down the maximum marginal tax rate in India. It's not going to happen in this budget, we know, but at some point in future, because that will spur investment, it will spur more confidence in the economy, and more money will come back in long-term investments, which is what we need in the country.
Okay. Well, run out of time. Thank you very much, Mr. Mistry, Anant, Sandeep, Mahesh, and Ashok, and Mr. Dinesh Kanabar. Let me toss to Shireen. She's also waiting with some guests.
Yeah, Lata, very quickly, we've got about 3 minutes to go for the finance minister's